Hi, good morning, everyone. Welcome to our Phillip Securities Research morning call for today. We have a few results and Phillip on the ground, some technical analysis, and Singapore REITs monthly, as well as the usual Singapore weekly. Yep. Then this is our disclaimer. This is just for educational purposes and should not be considered as financial advice. So without further ado, I'll hand over time to Darren to get us started on the Singapore REITs monthly. Thanks.
Yeah, thanks, Zane. Yeah, so for this version of Singapore REITs Monthly, we compile the first half results. So this is just the outlook, and we also combine it with the July performance. So the story is that in first half 2024 this year, the distributions are still under pressure, and we expect the DPU growth to return next year as interest rates get cut. Yeah, next slide, please. Yeah, so for the share price performance in July, year to date, all the REITs and all the subsectors are still down. But in July, the REIT index rebounded by 5%. So that's the right side in the chart. The best performer was the overseas commercial subsector. That's mainly because of Prime US REIT, because they managed to refinance their main credit facility. So after successfully doing that, their share price it jumped by 62.4%. And the weakest performer in July is hospitality sector. It was up 2%. Yeah, as the reason for that is probably because in the first half results we noticed that the hospitality sector, their RevPAR has moderated, so the growth has slowed to about 3 to 5% as compared to the previous year where the growth was always double digit, and the slower growth is also due to the higher base in 2023. Yeah, next slide please. Yeah, so this is just a snapshot of the results for some of the REITs we cover as well as some of the other bigger REITs. So the outperformer we see is CICT. They managed to get some DPU year-on-year growth, mainly from some cost savings and higher revenue and higher MPI. Yeah, most other REITs are still having negative growth DPU year-on-year. And the biggest drop was Prime US REIT, 92%. And that's mainly because in first half 2023, they still paid out 100% of their distributable income. But in the second half, or rather in the first half of 2024, they only paid out 10%. So this follows from the second half of 2023, where they also paid out only 10% of the distributable income. And as a result, the DPU year-on-year dropped, and now Prime's annualized yield has fallen to 2% as a result. Yep, next slide, please. Yeah, so we move on to the 10-year dividend yield spread. So what this means basically is how much investors are being compensated for investing in REITs, in the riskier REIT asset as compared to the 10-year Singapore government savings bond, or the risk-free rate. So now the 10-year dividend yield spread is at 3.2%. It has fallen by 0.1% month on month. And this is due to a few factors. So there are some movements over the month. So as the share price of the REITs it jumped 5.4%, the forward dividend yield it's come down. But at the same time, because of the Fed being more dovish, the 10-year yield also fell by quite significantly, by quite a significant amount, by 43 basis points. So as a result, net off the impact of the 10-year yield change wasn't that much. So as a result, it's just a 0.1% month-on-month decrease. But we expect going forward the 10-year yield to continue to fall, and we expect the dividend yield to stay continue to improve as like I mentioned in 2025 we expect some DPU growth, so that will likely increase the 10-year dividend yield spread back to the 10-year historical levels. As now it's still trading at one standard deviation below at the average of the 10-year. Yeah, next slide please. Yeah, so this was what I was talking about. The forward dividend yield is now, because of the share price 5% jump in July, is now fallen back to the 10-year average of about 6.1%. And the price to NAV still looks very cheap. It's still trading at around COVID-19 lows. So we think there is a potential, especially since with at least the market pricing at least 75 basis points of cuts by the end of this year. So we think that is a very good sign for REITs. Yep, next slide, please. Yeah, so we move on to some of the subsectors that we prefer. Despite the RevPAR slowing in July and a lot of the RevPAR numbers slowing in the first half, like I mentioned, to the first to mid to low single digit growth in the first half of 2024. We still favor this sector. So this is mainly because um, we think RevPAR growth will continue to be around these levels, and that will help to like the RevPAR growth will continue in the mid to low single digit levels, and that will continue to improve the MPI or the gross profit of these REITs. And we also think there's a lot of concert events lined up, like Taylor Swift, Coldplay. They're still doing their tour, so that will benefit RevPAR globally. And locally in Singapore, there are also many concerts upcoming, and there's also the F1. So we think RevPAR will likely turn around in Singapore as well. Like in July, it was down 3.1%, but going forward, we think it will turn. Like some of the more notable concerts that are upcoming are like Oliver Rodrigo, Dua Lipa, Imagine Dragons, Andy Lau and Jay Chou. So there's really no short of events or concerts in the second half of 2024. Yeah, and going forward, we also think hotel occupancy will likely improve. So now it's around 80 or rather 77%. We think it will likely improve to back to pre-COVID levels of above 80%. Hotel, the ADRs and average daily room rates, they have stabilized. So going forward, the RevPAR growth will come mainly from occupancy. As hotel, the ADRs have really grown significantly since the recovery of COVID. And right now, for Chinese travelers, it's really more than pre-COVID levels. So now, just for July's Chinese travelers were 6% above pre-COVID levels, and that's after the 30-day the visa-free Chinese the visa-free entry for Chinese citizens it rolled out on 9 Feb. So we've seen the recovery for Chinese tourism, and the international visitor arrivals we expect it to recover fully by next year, and right now it's still about 13% below pre-COVID levels. Yeah, next slide, please. Yeah, so for retail, even though retail sales are down and some downtown malls, they are also reporting lower tenant sales in first half 24 compared to a year ago. All of the retail malls and especially downtown malls, they reported significant positive rental reversions. So some examples are Suntec REITs, Suntec City Mall, Mandarin Gallery from OUE REITs and Paragon REITs, Paragon Mall, all achieved above 20% positive rental reversions. And for suburban malls, we also noted that the rental reversions were positive by high single digits. So FCT reported about 7.5 positive rental reversions, and CICT also reported about 9% positive rental reversions. So the positive rental reversion trend we think will likely continue, especially since a lot of the tenants, the outlook for tenant sales are strong and they are willing to pay these higher rents. And this is also supported by the limited availability of new supply in the market for retail. And one more thing for Singapore retail assets is that the valuations have remained very stable. As we've seen, Lendlease and Paragon REITs, their valuations in the first half, or rather as of June 2024, the valuations all improved by about 1 to 3% for the retail assets, and cap rates have remained stable. So for the outlook for retail, we're still favorable, mainly because of this positive rental reversion trend. Yep. So we now, I don't have slides for office and industrial, but I'll just give some comments for first half results for these two subsectors. So for office, basically the rental reversions in first half, it continues to be strong. It's about 10% rental reversions across the board for Keppel REIT, CICT, and Suntec REIT's portfolio. And tenant retention was also high in this quarter because the tenants are mainly, they do not want to spend on capex for new premises. And but the headwind is coming from the new supply in the market for office. As IOI Central Boulevard Towers, the phase 1, it completed in second quarter. So that is right now 45% pre-committed and another 20% that is in advanced discussions. So that added about 1 million square foot of space. And upcoming in 2025, there's also a lot of supply from Keppel South Central and the redeveloped Shaw Tower. So altogether combined, including IOI Central Boulevard Towers and the phase 2 of the IOI Central Boulevard Towers, it's about upwards of 2 million square foot of supply coming over the next 1.5 years. So because of that, we think rents will likely stabilize or even plateau and start being under pressure and come down in the next few quarters. Right now, it's at $11.95 per square foot per meter in second quarter 2024. So yeah, that's mainly we think it will come under pressure basically because of the fact that supply will outstrip demand. Yep. And for industrial, we've seen that rents are starting to moderate as well. So the warehouse demand from the third-party logistics is slowing and rising vacancies in business parks as well. So all this will weigh on reversions eventually, and we think going forward, the positive rent reversion will slow to the mid-single digit level as compared to the past few quarters, or rather the past few years where rental reversions for logistics were very strong, like in double digits, high up like 20% double digit rental reversions. But the drag for industrials is mainly in China, where the demand is expected to remain weak for the next few quarters. That's mainly because of new supply entering the market, as well as the weak economic activity and the fact that tenants, the incentives are also increasing. So the net effective rents are becoming lower. So we expect double-digit negative rental reversions for logistics assets in China for the next few quarters at least. Yeah. Next slide, please. So after the first half results, we've compiled our coverage and the change in recommendations and target price in this table here. So yeah, there are some changes. Like prime US REIT and such. Yeah, so this is just a table for you to take a look. Yeah, so that's all for me. I have no time to Zane to do technicals. Thanks.
Thanks, Darren. Good morning, everyone. I'll move on to the technicals. So first up, taking a look at the S&P 500, last week the index rose above the previous swing high resistance formed at the start of August, which was at 5,566 points, and then it did a retest before ending the week up, holding it as a support. So for this week, I think we are likely to see this bullish trend continue to do a retest of the previous all-time high at 5,670 and above. So for the current resistance, it's at 5,670 to 5,750 area, while the support is slightly between 5,550 to 5,585 area. And then for our individual counters, first up we have a technical buy for Alphabet at $166.67. Take profit levels at $173 and $178 respectively, with a stop loss at $161. Last close was $165.62 on Friday. Looking at Alphabet's chart, recently there was a breakout of a descending broadening wedge highlighted in blue, and then also price recovered above the $165 previous support breakdown level. Coupled with a fresh bullish crossover in the MACD, the stock could do some bullish reversal upwards towards these two take profit levels, which were prior resistances. The next one is a technical buy for RH Petrol Gas at 14.3 cents. Take profit levels at 15.6 cents and 16.1 cents respectively, with a stop loss at 13.4 cents. The stock last closed at 15.4 cents on Friday. So for RH Petrol Gas, the stock cleared the previous swing high resistance at 13.8 cents, and then afterwards it did a retracement to actually do this retest of prior resistance. It held as support with increasing momentum of the MACD holding above the zero line. So with that, the stock could do a rebound towards these two take profit levels. The next one is a technical sell stop for Bank of America at $38.38. Take profit levels at $36.50 and $34.20 respectively, with a stop loss at $39.70. Last close was $39.77 on Friday. So looking at its chart, there was a breakdown of this previous uptrend support line in blue recently, and then price shows through the price break below $38.50 level, which was this recent horizontal support. It could head lower towards these two take profit levels. So this is just a summary of the three trades initiated. Currently, Alphabet is down slightly 0.6%. RH Petrol Gas hit our first take profit level. It's currently up about 7.7%, and For Bank of America, the trade is currently not triggered yet because the price didn't cross below the sell stop level. Yeah, so that's all from me. I'll hand over time to Paul to talk about SATS results. Thanks.
Yeah, thanks. So I'll discuss SATS results on behalf of Miao Miao. She's on study leave. Next slide. So SATS gave a first quarter update. I think the update was above our expectations. In terms of the positive, the gateway revenue was one of the strong areas. So, and also the cargo. So they mentioned a lot regarding the cargo use remains strong. So what happened is that during the disruption in the Red Sea, and the port congestion, what you see is there's more demand for air cargo, and that's helping the business. Oh, so when we say gateway, sorry, for those who may not know, let me just dial back. So for gateway, we are referring to, when you just think of SATS always, when the plane lands in Changi, the people that comes on board to clean the plane, to put all the meals on board and to handle all the cargo, that's basically SATS people, SATS staff. And sometimes when you are checking in, there's also SATS staff. Just in case someone may not know what SATS actually does. The other thing that benefited was because of leverage. So when we see leverage, the margins improve. So the issue that SATS faced was when the pandemic opened. If you dial back 1 or 2 years ago, their margins was under pressure because they took in a lot of headcount. They expanded the headcount ahead of revenue, and right now that revenue is coming back up. Their headcount increased only 2-3% versus revenue, so they're generating a part of operating leverage. So in terms of outlook, I think the market is turning more bullish because they did a recontracting with SIA in April, but the pricing wasn't affected yet in the first quarter, not first half year, but in the first quarter, and it will only happen from second quarter onwards. So that's why the market is expecting stronger margins from SATS as they do the repricing. The second thing is also they mentioned that they are integrating WFS, which is a cargo handler in Europe and also in the US, which they didn't have presence. They acquired it, I think, end December, so that's also performing well. So we upgrade to neutral with an increased target price of 345. Next slide. So for China Aviation Oil, so for China Aviation, the results was within our expectations. So for China Aviation has two parts. So at the revenue line, what they do is the distribution. You notice the gross profit is 24, but they or operating 24. But the main one, the other part where they make a lot of profits is also at the associates. So associates is basically SPIA, basically in the Shanghai Pudong International Airport. They have a stake in, I think 33% stake, if not mistaken, in the refueling station. That means it's like a petrol station for any outbound flights you own. There's only one, so you have to rely on them. So they benefit when the volumes go up. So in the earnings jump almost 3 times, more than 3 times, or 2.5 times, from 8 million to 22 million. So firstly, what benefited was the jet fuel improved. So the jet fuel jumped 66% due to higher air demand. Most important was the margin. So you notice the gross profit doubled. Because for that, it's a bit harder to predict, but what they do is a lot of trading activity, basically back to back. So they are the biggest importer of jet fuel into China. So what they do is when there's a contango, that means when the curve, that means the forward oil price is higher, they will benefit higher margins. When there's dislocation, like in the Middle East, there was some tensions. So as a result, you have to source more from Asia, and then those who needed to source more from Asia and less from Middle East, actually they can generate incremental margins. The third reason why margins is a bit more a new business in a way that they're doing is they do more end-to-end sales. So in the past, they were just doing back-to-back. That means order taking virtually. But right now, I think somewhere in the US, they are doing end-to-end sales whereby they actually can order from the refinery direct, ship it themselves, and then deliver to all all depots in the US. So that gives them better margins than just doing back-to-back orders. Then of course the other thing that did well was SPIA. So that's easier to understand because when the outbound traffic in China recover, so their earnings, I think again more than I think almost tripled or 2.5 times higher. So we maintain a buy with unchanged target price. So we like China Aviation mainly because they have a bit of a monopoly status from the refueling, because like I said, it's the only jet fuel refueler in Shanghai Pudong, and also for their trading business, they are the largest, or they have a dominant share of all the jet fuel imports is handled through by them, the physical imports of jet fuel, because they're a state-owned company. Next slide. So I'll move on to BRC Asia, which is a reinforced bar company. Next slide. So just to backtrack, because these are small caps, so we may not understand. So BRC Asia is those reinforced bars and wire mesh. So basically, when you look at the construction site, usually when there's a concrete structure, you pour concrete into where there's a lot of reinforced steel bars there. So they are the ones who supply, and they have like 70% market share in Singapore. So the results was mainly below. So what I'll run through later. You'll notice that the profit was down 22%. Quarter on quarter is quite volatile because of so for the positives I'll explain later. But the positives is the order book is still robust, 1.3 billion, and their gross margins actually improve. So why the decline in revenue? Because what they mentioned is there's a lot of delays right now for engineering and architecture approvals by the approvals, of course, by the authorities. Of course, you don't write it in our report, but I think there's a lot of bottlenecks now in project delivery, and that's why the third quarter was affected. It is still there, but slightly improving. I think we maintain our target price. I think we lowered our earnings. Sorry, not maintain. But we still upbeat on the construction sector. I think for this year, private sector has been weak. So construction demand is either private sector or public sector or government jobs. So private sector has been weak, but we think it can recover because residential construction should improve as more launches continue. If you could recall, first half property sales was down, new home sales was down by 50%, but this should recover as more launches come up. And the more important one is there are the two integrated resorts or casinos, Resort World and Marina Bay Sands are undergoing a huge expansion and refurbishment. Each one of them are spending 6 to 7 billion, so which is so it total about 14 billion, which is huge over the next 3 to 4 years. Considering the construction sector in Singapore is about around 35 billion a year, so they will contribute very meaningfully, these two IRs alone. Then the public sector, of course, continues to be strong with new highways, new roads, new train stations, and new underground MRT lines. But the one that's going to get the big boost, especially next year, is the rollout of Terminal 5. So Terminal 5 is the equivalent of Terminal 1 to 4, I think, combined. So I think this is like a 13-year project, if I'm not mistaken. But what is happening is that by the tender submission is happening right now, I think, or end of this year. Then they will award the tenders by maybe Chinese New Year or just after. Then the actual commencement will happen in the second half. So that's where you're going to get a big jump in public construction work next year. Probably going to be more bottlenecks everywhere. Maybe crane rental or whatever. But at least in the meantime, the amount of orders coming up will be even stronger next year, especially with T5. At the same time, you have TOAS and so forth. Next slide. So I'll move on to Hyphens Pharma. Next slide. So again, let me explain a bit what Hyphens Pharma does. So Hyphens Pharma is in specialty pharma, which I think most won't understand, including me. But okay, specialty pharma until now. So specialty pharma mainly they take drugs that need doctor prescription, can be at the clinics or can be at the hospitals. So one of the things they do, example, is like when you need to do an X-ray and there's some special ink they need to inject in to see where the blood clots and so forth. So they do something like that. And of course, anything that needs drug prescription. So probably about 70-80% of the earnings come from that. Then the other one is proprietary brands. So proprietary brands is like Ceradan, eczema cream. You probably go Watson, you can see it. Or Ocean Health, the vitamins, I think most people know. And they do this medical hypermart, which is like they do distribution of whenever a clinic wants to order something, they will just call them and they will do the delivery. Of course, this is a huge scale. The earnings was within expectation. The specialty pharma, you notice on the left, there was a big 50% jump. So this is not because everybody, suddenly there's a lot of demand or a lot of healthcare problems in Vietnam, but mainly because last year there was a big collapse in the supply chain. So this one, they are just recovering. The negative is that there are the investment pain because they're investing in dog med. So what they're trying to do in dog bed or medical hypermart is like, you can think like a Lazada, but for doctors and clinics and for pharmaceutical company. So because they have got all the relationship with all the clinics in Singapore and also in Vietnam, they want to build like a portal where all the clinics can buy directly from pharma, and then the pharmaceutical companies can advertise. It's virtually like a e-commerce site. So that they are spending almost 6 million, so that is going to hurt earnings in the near term. That's why that was loss making. We maintain our buy recognition and target price. The stock is trading at about around, the stock is cheap, about like 8 times PE, considering this is a branded consumer product with regional presence. They have proprietary brands. Okay, so sorry, let me rephrase. So what's helping them to grow is that Ceradan, Ocean Health, they're distributing it overseas, like Middle East, and they also have new sales points in Singapore. I think they have new sales points like 7-Eleven or even Unity. It doesn't mean this will be generate huge sales, but at least it's a brand recognition too. And they got new products, including like I know gummies, also, especially to target the younger generation. Specialty, because they got new products and they can leverage on their network of doctors and hospitals in the region. Especially Vietnam, where they have a strong distribution network. Next slide. Okay, I'll go through the usual weekly. There wasn't really, there was not really meaningful news from Singapore, but for China, although this is a bit, maybe 1 week old, but China, looking at the data points, continues to be weak. So retail sales is improved from June, but it's still weak at 2.7, partly because it's under deflationary pressure, because the inflation there is actually negative. And the sales is really collapsed. If you think of pre-pandemic, retail sales in China was almost 9-10%. So now this probably dropped like 60-70%. Another contributor to growth, fixed assets used to be around 8-9%, now it's only 4%. So all these are all weak and still slowing down. Properties, no surprise, is still soft, and compared to pre-pandemic, it's down almost 50%. So no signs of a recovery. Maybe the pace of slowdown is slow, but it's still slowing down on most of the data points. Then of course we have the J Powell effect. On Friday at symposium, he virtually announced a rate cut on Friday. Just have to wait for September. So he announced that the time to adjust policy, basically to cut rates, it has come. These are his exact words, and because he thinks inflation is on a sustainable path to get 2%. I'm not so sure about that, but at least that's what he thinks, so that's good enough. Next slide. I'll just move on to, so technically our view is that, so he's effectively, rather than wait for 18 September, I think he just announced a rate cut. The base case is probably 1 rate cut. So the key thing the market will watch is on the 6th September, there will be payroll numbers, basically jobs. So if that is worse than the 114,000, the market expectation, then you could see the Fed cutting 50 basis points. So the weakening in interest rate is not just in the US, it's also going to happen in the Europe and UK, which already cut once and probably looking at 2 more cuts. Because even the latest data point, like wages, is also slowing down quite sharply. But for us, our tactical view is maybe September still strong. We are a bit worried of October, because we think with the US elections coming, a lot of the US investors might probably stay on the sidelines because you're not sure where the policy will shift, depending on who wins. And of course, we still think that a lot of the data points might still suggest slowdown. So in the US, so if you adopt a more defensive posture, then you'll be looking at REITs, land transport, telco, construction. For the semiconductor results, I'll run through all the 4 semiconductor names. Although because I think we get a lot of questions. The one that has the best results was, of course, Franken and Grand Venture. I'll explain later why. The worst was UMS and EEM, mainly because of specific customers, but we'll talk about it later. The main highlight for this week is going to NVIDIA results on 28 on Wednesday. Then after that, on Friday, you're going to have the US inflation numbers. This week, we're going to have three corporates presenting. It's open to everyone. We have a Capital REIT. We have a VinFast, of course, the Vietnamese EV. And also, we have micromechanics. If you want to know what's happening in the semiconductors. So these three will be presenting. Next slide. Okay, let me just run one by one. I go by the largest one, which is UMS. So UMS, for those who do not know, they are semiconductor equipment components. So they make the components, and the one that helped them grow a lot was the assembly. And so they assemble a lot of their main customers. We believe is Applied Materials. So the profit is down 23% second quarter. You can see from the You can see from the left here, the net profit 23%. Then, so what is happening is that their main customer, the orders are not strong, number one. And the second thing that's affecting, which going to linger, I think, into the second half, is they lost a bit of share. So there are two major suppliers for this. I think the Endura machine. The first one is them, and the second one is a Malaysian listed called SAM. We think their market share probably dropped from 70 to maybe slightly above 50%. So that's one of the reasons why. So the customer order less and they're also losing share. The third reason why they're weak is because their new customer, which we believe is Lam Research, they have a new plant in Penang, but the orders is below expected. The orders are there, just that when, let's say, they build a part, it takes a very long time for the customer to approve. And in this business, most important is high utilization of the machines. So when you're slow, you can't run the machine 24/7. It's going to hurt your margins because you're going to start depreciating. So even though they got orders, maybe 30 million this year, it's not going to contribute to the earnings. The other thing to watch is they're going to do a secondary listing in Malaysia, probably middle of next year. No new shares. It's fungible, so they hope that Malaysian investors will buy up UMS because it's cheaper than Malaysian stock. But I'm not sure whether that will happen. But anyway, that is the game plan. Second half will be stronger, but I think it's still going to be weak. I think second half, this stock again is probably going to be the 2025 story. More important is when the new customer will start to contribute. So they still think this customer will be meaningful. Best case, they will contribute 300 million in 5 years. Worst case, maybe by 8 years. So 300 million is huge. It's like almost double their current revenue. So it's all about this, how fast this new customer can ramp, which we don't think, we think it's only 2025. Next slide. So I'll go to the next one. So second largest is Franken. So Franken, let me just go brief a bit. So they do precision parts components, but they do a lot. They do for semiconductor, they do for hard disk drive equipment, even auto parts. I think some of the customers for auto is like Mercedes and Ferrari. So their earnings did very well. They're up 50%. Analyzed PE about 14 times. So for semiconductor, what actually helped grow was mainly their front-end customer, which is essentially, I think, is ASML. So ASML is restocking. And they're also getting new products from ASML because the ASML, I think, is shifting some of the production from Europe to Asia. So they got a double benefit. The customer restocking and they're getting into new products for ASML. The life science, that one is steady state growth. And the industrial equipment, that's the one that's the weakest. You look on the left, the one dropped 60%. So that is mainly hard disk drive. So I mean, don't hold our breath. Hard disk drive not doing well. So what is happening for the outlook is you think there'll be a gradual return. So I think third quarter will still be strong. Because they are working on the latest products for their lithograph customer. But I think the issue will be fourth quarter. I think so fourth quarter a bit more careful because fourth quarter of last year, they did really well because their Chinese customer put back forward some orders. So if you dial back to fourth quarter of last year, they did very well because the Chinese were trying to load up the orders before some of the restrictions came in. So that's why I think fourth quarter this year, they won't get the kind of benefit. But third quarter earnings will still be strong. So among the four, I think this one will have the best momentum as you go into third quarter. Next slide. Okay, AEM. So AEM was a disaster. The earnings down, I don't know, 90% or whatever. Barely profitable. I mean, 800,000. Of course, there was a bit of an inventory write down. So the earnings down 95%. So AEM, for those who don't know, they are a semiconductor test equipment manufacturer. So they do their own branded names now, not just sell to suppliers. So their key customer, which is we believe is Intel. So 90% of their demand is actually from this one customer. So Intel is facing headwind, as we all saw the news. So Intel is cutting costs because their revenue below expectations, and they're also cutting capex. So that is hurting AEM. I don't have the exact number, but I think they're cutting capex for 2025, maybe 20-30%. I think we all know the problem at Intel. So Intel missed the move to mobile. They also move AI. So not sure what else they're going to miss. But okay, so the main thing for AEM is their new customer. So they have the second AI GPU producer, which I think most likely is going to be AMD. So that will start to ramp in fourth quarter, and they're still guiding triple-digit million, which can be 100 to 999. So, but I think probably more like 100 million plus for revenue. That the thing is still intact. So 2025 is where they'll get the rebound from the new customers. So for second half, they are still guiding a week. So second half is still going to be weak. So you're looking at maybe as much as a 22% decline in revenue. It won't be as bad as first half, but it's still going to be weak. So again, this stock probably more of fourth quarter stock, I think, because third quarter will be weak. Then if there are signs of the new customer ramping up, or maybe Intel recovering for whatever reason, then that should help them in the 2025 or fourth quarter. Next slide. So the last one is a Grand Venture Tech. So think of Grand Venture like a Franken Mini-Me or smaller scale Franken. So they do almost the same things and same industry. So the earnings recovered, but that's because first half their earnings fell 2052. But what is helping them, just to give you some color, is actually the test equipment for HBM, which is high bandwidth memory. So high bandwidth memory is like whenever you have an NVIDIA chip, you need memory so that you can draw the data and process it fast. So a lot of them are using high bandwidth memory by the Koreans, and one of their customer, which we think is Teradyne, we don't write the name down, but it's T, and the other one is probably Kohu, a smaller scale, but that is the one giving them a lot of growth. So if I jump to the outlook, so they are positive for FY24 because I think this HBM, if you listen to Teradyne call, they are also guiding very strong because of HBM. And 2025 will still be strong. The kicker which all electronic semiconductor companies are praying for is this edge. That means if AI in the phone take off, then that will do well for them, plus they got contributions for front end. So the interesting thing about Grand Venture is that they managed to penetrate into front end. So front end is like maybe like applied and so forth. So that hasn't contributed. And in 2025, if that start to contribute, because the value is higher, the margins is higher, then it's a totally new customer, and there are 4 of these customers. So if that kick off, then their 2025 earnings will be even stronger. Probably the fastest growing among all the 4. But only thing, you just have to stomach the PE, because the historical PE now is already 19 times. So what happened for them, why they're doing so well, is that they took the pain. The last 3 years, they spent a lot on capex. For a small company like this, they spent like almost 30-40 million on capex, which is huge. I mean, compared to a small company. So and that impacted their cost, but then now they're starting to get the benefits. So probably take them is probably the fastest growing among the 4. If the front end kicks in. Yep. Okay. I think you can. I think can end it now. It's long already for. Thanks everyone. Move on to Q&A.
Let me try to take some first. Why are investors not seeing the value and potential of CLI, judging from the lackluster performance of the share price? That's actually a very good question. I also wonder sometimes, but the thing is that I find investors are putting a lot of pressure on the China portfolio, as they should, as it's still quite weak, where there are rental reversions across all the sectors for first half 2024. But as we see them trying to divest some of their China balance sheet assets and hopefully they can find an investor, and then they can eventually move those assets into a fund structure where they continue to manage and like the assets and collect property management fees, and they lessen their weightage. Like maybe they still own a sponsor stake, maybe 10 to 20% only of the stake in those China assets. So that will likely benefit them in the longer term. And in the near term, they're also hit by high interest rates as well. So that is why I think probably they're trading so weak. But we've seen their share price post the results have kind of increased by about 5% if I'm not wrong. Yeah, so the management, they also have a view that is their share price is severely undervalued, as they have a 5% share buyback mandate. So they've been buying back shares in the open market for the past few months already. So that will also likely help to support the share price. And yeah, we think there is a lot of potential for CLI's share price going forward as they improve their fee-related business income and lower their balance sheet Chinese assets on the balance sheet as they divest some of those. Yeah, I hope that answers that. With the strong Sing dollar, do you expect a fall in visitors to Singapore and hence negatively impact retail, hospitality, medical REITs despite impending rate cuts? Yeah, so impending rate cuts will definitely benefit the REITs, but even with the strong Sing dollar over the past few months, we've seen the fact that international visitor arrivals still continue to improve year on year. It's about 16% up. 13% up year on year in July. So we're still expecting international visitors arrival to reach pre-COVID levels by next year. And STB is also forecasting that. So we do not really expect a fall in international visitor arrivals going forward, despite the strong Sing dollar. So as a result, retail hospitality still remains resilient in our view. What is your view on the impact of RTS on future retail S-REITs? Yeah, so the impact of RTS is two ways, right? So because of the so-called strong Sing dollar compared to the ringgit, but even though it fell quite significantly over the past few months, Singaporeans are still already going there to shop for like their groceries and such. But that is a two-way thing, because with the RTS, more Malaysians might also come to Singapore to work. So it will probably benefit the retail side in Singapore as well, especially when Malaysians come to Singapore to work and they spend at perhaps the suburban malls. So suburban malls will likely benefit like from F&B and such. So yeah, it's the so-called the leakage from Singapore to Malaysia from the grocery spending, like the necessity spending, is already happening. Like Singaporeans are already going there. So even with the RTS, I'm not sure whether that will really have like more Singaporeans will already go to Malaysia because of the RTS. I think those who are already going to Malaysia to buy will continue, and I doubt many more Singaporeans will go. So I think it's more beneficial to Singapore for this RTS as more Malaysians come to Singapore to work. Yeah, and spend here. Yeah, I think that's my take. Is there any new update from EC World REIT? Yeah, for EC World REIT, the sponsors still not paying rent, so they've not paid dividends for the past 1.5 years. Yeah, so other than that, I don't see any further updates. From the collection of payment. So their most recent results also, they declared that still not paying rents, and they also had some significant devaluation of their assets. So yeah, those continues to hurt EC World REIT. Any specific REIT subsector or specific counters most sensitive to interest rate changes? Yeah, so for this is we look at the percentage of debt that is on fixed rate or the percentage of debt that are hedged via interest rate swaps to fixed rate. So the beneficiaries for any interest rate cuts are those with a lower fixed rate or a lower hedge rate. So two good examples are Suntec REITs. Suntec REITs, their hedging is about 50%. So if interest rates come down, they'll benefit a lot from any interest rate cuts. And another one is Fives Hospitality Trust. Their hedging ratio is only 35%. So these two REITs will really benefit significantly from any rate cuts. And yeah, their rate change will change quite a lot when interest rates come down due to the low hedging ratio. Yeah, there's one on Bitcoin ESL logos. What's the debt level? The debt level for ESL logos is the gearing is at 36.5%, and 75% of their debt is on fixed rate, and their cost of debt is about 4%. Yeah, the price have been depressed here. So they've been divesting assets. So as a result, their revenue and MPI has been coming down, and their DPU is also hurt because of that. Yeah, but I can't really comment because they didn't invite me to their investor briefing, so I'm just looking at the slides, so I don't have more insights for that. Yeah. Yeah, I think I'll hand over to my colleagues first. Thanks.
John, you want to take some in the TC Auto also, in the sales force also, for Ambrish?
I will take the Salesforce question. So, what to expect from Salesforce results this week? So, basically, Salesforce is expected to report its second quarter results after hours of this week on August 28th. So in terms of the top line growth rate, the revenue over the last 5 quarters, it has grown by about 11% year over year for the last 5 quarters. And but in the second quarter, it's expected the revenue growth rate to grow by about a single digits by about 8%. And the drop of about 2 or 3% this quarter, it's mainly because the management had highlighted that it's witnessing like slowdown in corporate spending, and as particularly the large deal sizes, it's impacting the slowdown in consumer spending, and also shift towards AI investments. Whereas in terms of bottom line, the earnings, it's expected to grow by about 10 or 11% on a year-over-year basis, and this is mainly because of focus on high operating leverage. And despite the slowdown in the second quarter, the company, it has reiterated its full year revenue growth outlook, and it reiterated that it still expects the full year revenue growth to of about 10% on a year-over-year basis. So for this quarter, we need to wait if the company makes any revisions to its full year outlook. So overall, for Salesforce, we have a buy recommendation and with a target price of $305. So hope that helps.
Yeah, hi. Thanks, Ambrish. So there's a question here. Was there a briefing on TC Auto, which is Trans China Automotive? Can share any details on it as the stock is up today? Yeah, so actually TC Auto is one of the largest I guess luxury car dealers in China, and they predominantly carry BMW, both the obviously your ICE vehicles as well as the EVs, and then they also carry McLaren and Genesis, which is the premium uh, Hyundai, I guess, range. essentially, yes, they had a briefing a few weeks ago, but the results were quite poor. Overall was very poor, mainly due to continued weakness in the consumer spending environment in China. They're mentioning that actually they continue to lose money on every car they sell because of pricing. And that really had a negative impact on their margins as well as their bottom line. But in terms of outlook, they did also mention that um, uh, that they weren't really sure whether, referring to the EV specifically, whether the competition had actually bottomed. But they do think that at least they are closer towards the tail end, as they're starting to see a lot of I guess smaller independent EV brands start to drop off and file for bankruptcy. And so there's a little bit of consolidation happening in the EV market, especially in China. In terms of overall spending for just luxury vehicles in general, this is still quite weak. And it's not because the consumers don't have money. It's just that sentiment is so poor that consumers in China are actually not willing to part with their money. So the savings rate has actually increased quite significantly. There's just a lot of money on the sidelines, waiting and waiting for improved, I guess, macro environment to resume spending. So I don't really have any ideas why stocks up so much because results were quite poor. I think perhaps it could be just investors thinking that indeed the macro environment, at least the EV industry, is bottomed or is close to bottoming, and so they're just averaging in. Yeah, but not really too sure exactly why the stock's up today. I hope that helps. Maybe I'll hand it back to Paul or the rest of the comments.
NVIDIA, there's one question.
Oh, sorry. Let me find this NVIDIA one. What to expect from NVIDIA results this week? So I guess the expectations are high. For myself, I mean, for NVIDIA, even though they did, there were some reports that there was going to be a delay in their Blackwell shipments. Well, I think not just myself, but the street as well is expecting quite good results. Demand is still quite high. At the same time, when you're looking at their rep, they always tend to underguide and overperform. And naturally, when you look at their main competitor, AMD, which reported almost a month ago, results for AMD were extremely positive, especially for their data center GPUs, which NVIDIA has 85-90% market share. So the expectation, at least for me, for NVIDIA this week is still extremely high. We expect them to outperform both guidance on top and bottom line. Expect the commentary, outlook commentary to still be very positive, especially as demand still remains quite strong. And then when you look back and you think about what hyperscalers, essentially their customers are saying that they're just going to continue spending regardless of whether they see a significant upside, because it's better to overspend. That kind of gives you an indication that demand will still remain fairly strong, at least for the near term. Hope that helps. I think maybe there's no other questions for me. I'll hand it back to the rest of my colleagues. Thank you.
Yeah, I think for NVIDIA, although nobody asked me, but anyway, I think for NVIDIA, I think it probably can run until the new Blackwell chip, because I think once the customer, the view is that once the customer gets the new Blackwell chip, which probably going to be early next year, then I think that gives them maybe give some justification to maybe just slow down a little bit, because they already have the very latest version, and then they might just pause a little bit. So I think that is the time maybe might hit NVIDIA more, probably early next year. Because once they already bought, the customers already bought H100, the one that was launched, then the Blackwell one, which they are all waiting in queue, after installing that, I think they might pause a little bit. I mean, that's my own guess. Because that is the most expensive, and after that huge jump, I think they probably might have to pause a little bit, just to at least get some revenue out of all these investments. Okay, let me just move on. What is driving the recent surge on SGX shares? Not because of the results. I think the volatility recently has probably helped my own guess. Because with interest rates coming down, actually that will be a headwind for them. So SGX benefits from basically two areas. It's either interest rates or volatility. But volatility in July was already good. I think if you look at Glenn's, he's on leave today, but if you look at the monthly, I think they're up maybe mid-teens, but with the recent jump, with the recent yen carry trade kind of spike in volatility, so maybe people are and jump in VIX, so maybe the expectations is that the results could be coming in stronger than expected. I looked at the dividend yield. Actually, dividend yield is only like, I think, less than 4%. So I don't think anything interesting on that part, or I don't see any new listings coming, or don't hold my breath, but so I think maybe the volatility probably made people a bit more upbeat, my own guess. With the worsened war situation in Middle East and Russia, Ukraine, what is the possible impact you think of Singapore shares? It definitely could be negative, for, I think, without stating the obvious, because Singapore is so reliant on global growth. And whenever you have such incidents, you will notice all the corporates will pull back. Consumer will pull back, corporates will pull back, and you will just slow down the whole economy. Don't talk about the tail risk of major conflict and so forth. But in general, any worsening in the geopolitics just makes it worse. I mean, yeah. And of course, oil price will be the one to watch. Oil price might rise, but if they strike any of the oil facilities, then I think oil price is the thing that will get a big spike. Because so far, despite this war in Middle East and Russia, you notice everyone has stayed away from attacking the oil facilities. So if that really happens, then it will take oil price probably another new level, because then there'll be real disruptions to oil supply. What's the outlook for positive stocks, for Singapore stocks on positive GDP numbers? Which sectors can outperform? So if you look at the recent GDP numbers, I didn't go through because I don't really look at GDP, but they are guiding to the upper end of the forecast. But where the surprise came was manufacturing and construction. Those are the two areas. And of course, the usual like finance. These are the three main areas, services. So for manufacturing, the sectors performed should be electronics and construction. I think these are the two main ones that should benefit. But I mean, for Singapore stocks now, of course, we see all the marine sector is also doing well. Yeah. What are the top dividend stocks you recommend? It's probably going to be the REITs and banks. So like DBS, and then for REITs, I think I'll leave it to Darren later. What's the outlook on Marco Polo after their last week's? Yeah, I think they're having a briefing at 11 a.m. now. So our analyst is attending, and then we'll try to get back to you on the latest update. But just to sidetrack a bit, what is benefiting right now is really the FPSOs. So that's the one that's helping, of course, Dynamic to a certain extent, Beng Kwang too. It's a FPSO. What's your take on Powell's tone during Jackson Hole? I think we discussed it earlier, but basically he's just telling you he's want to he basically just cut rates already. I think you know they won't disappoint. The market is really expecting, and with the market so fluid, if they don't cut rates, then I think the market will go into a tailspin collapse. I'm not collapse, but there'll be some big sell-off if he doesn't cut. So, and they normally don't guide this way. It's all well orchestrated. Yeah. So the tone is just to cut that to be, yeah. How's Silver Lake's results? Okay, so Silver Lake's results was very weak. I mean, Glenn's on leave. It was very weak. Okay, the issue for Silver Lake right now is that they are not getting the very strong 70-80% license profit. So for Silver Lake, for those who don't know their software, I think of the 3 banks in Singapore, they are the core banking software for 2, and they probably got 3 to 4 in Malaysia. But the problem, these are the old mainframe SIPs contract, and they're not getting new license, and that's the best part of the business. and then the cost look to be a bit on the high side. They are suspended for some corporate exercise, which I'm not sure what is it, but it could be could be a positive one. I'm not sure what is it. Maybe I'm not sure, is it a takeover or a privatization or whatever. But the results wasn't strong. Because they are losing out on the license, and they are moving into a cloud-based business, which is very new. So they're facing a lot of costs because this is a new 1-year product. So in general, the results was disappointing. How about any growth prospects for Hyphens, or is it more of a dividend counter? For us, it's a bit of a blend, but it is a growth. But for Hyphens, I think we've always mentioned this is a long journey. I think to build a brand, they're virtually building up from scratch. So, but they're doing well in it, but it will take, you're looking at maybe low teens style of steady state growth for them. And low teens steady state don't really excite investors. I know Singapore investors for mid cap, you need at least 30-40% growth, then everybody start to jump into your stock. But this one will take time, and they are trading at for us it's attractive, but it will just take time for this thing to build, because you build a franchise like this, it takes time to build, to brand build, distribution, and new products. So the unique thing is that they may launch a new product this year, but it actually contributes to revenue only 2 years time for those specialized. And you're beginning to see some of it now, but it takes time to build the pipeline to stack it up and then start to contribute, because they lost one big one, which is the biosensor, which couple of $1 million of I think 1-2 million profit. I think they got hit by that, so that's why it took time for them to rebuild. So this one is a long journey. It's not like a semicon stock you can play by quarter. I think my own view on this. Have banks reached peak earnings since earnings? Okay, I'll just answer on behalf of Glenn. Okay, so for banks, if there's a 1 or 2 interest rate cut, it won't impact them because they're already prepared. What they're guiding is that they've already hedged their books. Basically, for a bank, when they take money, some of it they lend out, some of it they keep it, a lot of it they buy bonds and all that. So what they did is they raised the duration. I mean, they basically bought maybe a 10-year bond. I'm giving you an example of 10-year or 5-year bond. So their interest is locked in already. So they're not worried of interest rate cut if it's a 1 or 2 or even 3. But once it goes to 4 or 5, then where you see the NIMs compressing. So basically for the second half, I think no issue in the earnings. And with wealth management coming in, I think something like what you saw on SGX, when there's volatility in the FX market, a lot of the clients will want to hedge more. So I think the bank's third quarter non-interest income should be very strong because of all this volatility, especially all this yen carry trade and all that. So it causes their clients to hedge more and provide more flow. Although we can never quantify, we don't have the data, but once the banks get more flow of clients wanting to hedge, they are not wealth, and also with the turnover in XGX for once getting higher, so it means the clients will be more risk-taking, and then they will take their money out of deposits and buy more wealth management products. So these are the 2 things that will help their non-interest income. So I think third quarter should still be strong. I mean, if it's just 1 or 2 rate cuts, should be no issue for the banks. What would the market be looking out for the next Fed meeting after Powell already? Yeah, I think like we highlighted, we won't be looking on the 18th, like we have mentioned, they're looking on the 8th of September when the payrolls are out. If the payrolls are within expectations, it'll just be a 1 rate cut. But if it's below, then it'll be like a 2 rate cut and so forth. But do note now, historically, when the Fed cut rates, doesn't mean the market will rally. It still depends on whether the economy holds. If it's so we might get 1994, 1995 situation when the Fed cut rates and the market still ran because there was a soft landing. So that could be one scenario that could help the bank, the equity markets. Most times when the Fed cut, I didn't have the chart. I mean, I think we showed many times before. When the Fed cut rates, cut interest rates, the market can actually come off because it usually forward with a deep recession. Any info on Infotech, Innotech? So Innotech has been getting a lot of interest because what we understand is that they've entered into PC server assembly work for AI. Okay, let me just rephrase. On the AI server, they managed to get some projects to sell components for and assemble the piece, the servers. I know, for all these GPUs, NVIDIA chips, you need to put it in the like a PC, like in your house, this big PC server. I mean, it's not that, but something like that. So the earnings was hit mainly because they had to do some inventory write-off. But I think half of their market cap is in cash. So I think it looks okay. Just that, this type of stocks, you probably won't get any news until the year end. So maybe people just sell off a little bit. But apparently they are still in this program, and and they got this really good program to assemble AI servers, if I'm not mistaken. Hypo, do you see the escalation by Iran soon after the exchange between? I don't think so, because I think like US has an aircraft carrier there, so I think if Iran escalate, then I think I think I'll be worried if I'm an Iranian. You got an aircraft carrier just quite near to your country. Yeah, so I don't think you want to go and stroke this thing. Yeah, my own view, they just use Hezbollah as their proxy to go and attack Israel. Yeah. Again, all this is really hard to answer, but this is just my own guess. Yeah. If Grand Venture does get some orders from Applied Materials next year, what would the impact on UMS? Yeah. Okay, so Grand Venture, I think, is getting it through SAM, like we mentioned. There are two major suppliers to Applied, which is UMS and SAM. Yeah, it's the one in Malaysia, SAME, Semiconductor Advanced. I forgot the rest of the M&E, but you can go and Google it. But we think Grand Venture is also getting some from ASM International, maybe some from LAM Research too. So it's not just one, they have like 4 customers. So yeah, but UMS is not directly impacted by Grand Venture. It's through the SAM, SAME. Is Franken valuation expensive now? Yeah, I don't think, when I look at the back of envelope, I think Franken now probably like 14 times PE versus Grand Venture. Yeah. But Grand Venture is probably like 18, 19 times PE. FY24, again, these are back of envelope under updates. Hi, Paul, what's your view on the new yen carry trade? Yeah. I'm not sure you can do a yen carry trade or how much you can do, because the currency is well controlled. To do that, you need to have enough offshore yuan. I'm not an expert in this, so I'm not so sure about that. Yeah. Even if rate cuts take place, okay, this one's a read question. I'll leave it to the comments on Bit2. I'm not sure. Will rate cut benefit crypto? I think I'll leave it to John about this. Yeah. Is SCS right now because BlackRock back the shares? Possible, but BlackRock could be buying because of the ETF. I'm not sure. Yeah. Oh yeah, BlackRock became a major shareholder. Yeah, you're right. In that sense. Yeah. I missed that. Yeah, sorry. Yeah, there's this news. Yeah. You said banks and REITs are sectors to go for it. I saw REITs moving up, but banks are coming down lately. I think the markets are just pricing in for this easing cycle. Yeah. But if it's benign, I think banks can still hold their performance for the next 6 months. Yeah. Because I think the fee income should be really strong. Like I said, the volatility benefits the banks for the FX desk, because they want to do more hedging. Oh, okay, I hand it over to John and Darren. Yeah, thanks.
So there's a question on SG logistic REITs fundamentally sound. Yeah, so for logistic REITs, like I mentioned in the presentation earlier, we think that the Singapore logistics REITs, the rental reversions will likely to come down to the single digit level, because over the past few years it has been double digit, and from the so-called super cycle from the e-commerce boom, so that really helped to the logistic rents basically back then, and warehouse, it just shot up because of the e-commerce boom. So now it's starting to slow down and normalize. We've seen that from the prime logistic rental growth also. It's basically it's slowed to 0.5% quarter on quarter in the second half of 2024. And also there's quite a significant amount of supply that's coming over over the next 2 years. So that will also likely impact the logistics demand. But it is still fundamentally sound, but rental reversions and the rental growth will likely to slow going forward. Yeah. There are some asking for updates on Manulife US REIT. Yeah, so for Manulife US REIT, There are basically no update since the first half 2024 results, but the biggest thing to highlight is that the progress of their disposition mandate. So the disposition mandate right now, they have so-called this disposition mandate to sell off some assets that they've classified in tier one tranche. So this tier one tranche is the weaker, they are weaker properties where even if they invest some capex into it, they don't see the potential return, or the return, they don't see it as sufficient even after investing this capex. So they rather divest these assets. But the thing is now they're having trouble trying to divest these assets as the beta spread is still very high. And that they did mention that there are some buyers interested in their properties, but my view, I think personally that their offer price is way below anything that Manulife can sell those assets for. So as a result, yeah, it just doesn't match. So they can't settle on any divestments. But they have this deadline by June 2024 to divest. I believe just off the top of my head, I think 328 million worth of assets by June 2025. If not, they'll have so-called breached this recapitalization plan. Of course, they have this structure where they have to divest this amount, 320 plus million by June 2025. If not, the plans like the 1 year extension of the loans, all these will so-called be in default. Yeah, so that is still a headwind for them. And on top of that, they have a December deadline or so. If not, to divest some assets by then. If not, they have to incur a small fee. So that is like a intermediate term before the June 2023. So yeah, going forward, we still see quite a few headwinds for Manulife, mainly because it's still very challenging for them to divest any of these assets. And that is just the divestment part. Fundamentally, but on the operation side, they are also still weak. Their occupancy has fallen to 70 plus. Rental reversions are still negative. Tenant incentives relatively stable, but net effective rents are also very weak. So yeah, it's still very challenging for the US basically. Yeah, but for Manulife specifically, they have this disposition mandate they have to execute, and yeah, it's in a very bad situation compared to the other two where they have not breached anything. So yeah, Keppel Pacifico and Premier Street, they're doing much better than Manulife. But it's still weak in for USS. The main issue is that the US banks are not lending. So if the US banks are not financing any US real estate transactions, so basically any buyers are just pure equity or private equity buyers. So high net worth individuals as well. So basically, if banks are not lending, it's much harder to let go these assets. Yeah, so there's an update on Manulife. Yeah, there's a very good question from CK Lai. Even if rate cuts start to take place, the resultant rates are still higher than pre-COVID levels. Hence, REITs refinance, they still need to pay more loan expenses compared to pre-COVID levels. Is this correct? Yeah, so you are absolutely correct there. Yeah, and you said dividends will still be lower compared to pre-COVID levels. Yeah, so that's all correct. So as a result of those headwinds that you mentioned in your question, personally, I also feel that the REITs, after their share price kind of crashed since COVID and is much lower than pre-COVID levels as well. We don't think that the REIT share price can reach pre-COVID levels in the near term unless interest rates go back to pre-COVID levels, like basically like when the Fed rate was 0. So that is a headwind. But the thing is, since the dividends will also be lower because of the higher finance expense that they have to pay compared to pre-COVID levels, the share price has also come down significantly, and we do not see the share price recovering back to pre-COVID levels anytime soon. So as a result, the dividend yield based on that is still palatable in a sense, because with the lower share price, lower dividends, you still get a solid yield. And as compared to pre-COVID, where you got that same DPU and but it's based on a higher share price, so your yield is also around that same level. So that is why I also had that forward dividend yield curve or forward dividend yield graph to show you the dividend yield compared to historical levels. So right now, if you invest in REITs, you are getting about 6.1% forward dividend yield. So that is, if you compare that to pre-COVID levels, it's still considered relatively attractive because of the lower share price. Yeah, so I hope that answers the question. Yeah, I hope I made sense there. Yeah, Mapletree or industrial or Ascendas in terms of valuations. Yeah, so just purely in terms of valuations, Ascendas is trading a little bit cheaper than Mapletree because they're trading at about 1.2 times for Mapletree Industrial, and Ascendas about 1.15, and Ascendas is also trading at a slightly higher dividend yield. Yeah, so just purely in terms of valuations, Ascendas seems like a better buy. Comments on Keppel DC REIT, please. Yeah, so for Keppel DC REIT, their fundamental portfolio, if you minus the China side, is doing very well. Like in the most recent quarter, they managed to have one co-location renewal of 40% rental reversions. So that's very strong. But the headwinds still remain for Keppel DC REIT, especially the China side, where they have not received much payment from there, and yeah, it's likely that they'll have to make some more provisions in the second half for the China assets. But the thing is, Keppel DC REIT now is already trading at 1.5 times price to book, and their dividend yield is also not very attractive. Their dividend yield, if I'm not wrong, is 4%. Yeah, is 4% after the share price run or so. So yeah, our target price is actually $1.93 for Keppel DC REIT, but now it's already $2 plus. Yeah, so that's my comment. Yeah, I'll hand the time to John maybe. Yeah, thanks.
Yeah, thanks, Darren. So there's a question here on Bitcoin. Will rate cuts benefit crypto? So in general, I would say yes. If you look at historical trends, typically, because it's a risk-on asset as well, got an inverse relationship with the Fed funds rate. But that being said, during this whole period of high interest rates over the last 2 years, or at least the last 18, 19 months, Bitcoin has basically gone up 4 times from 15,000 to like now 60,000 plus. So there kind of is a relationship between rate cuts and crypto prices going up, but it's also not really that definitive. But when you look at just recently, the price movement, especially when there was Powell made the comments during his Jackson Hole symposium, I think on Friday, Bitcoin rallied 6%. Ethereum as well was up quite a bit. So, yeah, I want to say yes, but if you look at the very short history of Bitcoin, it's not that definitive per se. But typically, if any monetary easing policies like rate cuts, should benefit cryptos, Bitcoin specifically. Yeah, hope that helps. We'll hand the time to Zane to do some TA. Well, thanks.
Yeah, thanks, John. I'll start with the TA. Yeah, so first question is on AUM. Yeah, so AUM currently price looks like it's holding the $1.20 support currently. So I think price currently bounce off over there. It's sort of still sideways around $1.30 about that. So I think short term wise, I think price could still do a bit of a sideways with some resistance ahead with around 137 to about 142 area. Then short term support will probably be around 124, 125 or there. Yep, then for CDL Hospitality Trust. And for CDL Hospitality Trust, I think there's some rebound, but I think it's towards a previous resistance area. So this was around 92.5 cents to about 93.5 cents area. So could see some resistance for the time being. Then price could do a bit of a consolidation. Short-term support could be around 90 cents to 90.5 cents level. Yeah, then for Far East Hospitality Trust, I think it's doing a retest of this prior resistance area around 63.5 cents, 64 cents. But I think the chart has looked better because this time it managed to break above this 62 cents to 62.5 cents area. So this will be like the support for now. But I think as long as price is able to hold this level, which is this range consolidation breakout area, I think it could go higher in the near term. The next resistance next resistance could be around, I think around 65 to 66 cents area about there. Okay, then next one are some US stocks. So first up is Palantir. I think for Palantir, we look at the bigger picture wise, it has actually rallied towards this channel resistance over here. Price is currently doing a bit of sideways. So I think some resistance currently around the $33 mark. I think for now, price probably do a bit of a consolidation with support probably around $31 about there, which is this breakout level as well. So probably between trading sideways between 31 to 33 for the time being. Okay, then for Nvidia, I think price currently is doing a bit of a sideways, but the good thing is that it's still managed to hold this previous resistance at 124, 125 as support last week. So I think with that, if price can break above this 130 short-term range resistance level, I think we could see price continue its momentum upwards towards the next resistance around 135. Then for AMD is also quite similar. Last week, it did a retest, went above this previous swing high at 153 and did a retest, held as support. So I think short-term wise, it could do a bit of a range, but with some resistance still at 162, this recent high. But I think overall, as long as price is still holding these recent lows on Thursday, Friday, I think it could still continue this either sideways or upwards momentum next. Yeah, above 162, the next key resistance probably is around 106, 170 about there. Yeah, then for AMAT, AMAT slightly weaker. I think probably still kept in the range for now. This previous resistance at 212 still holding out as a resistance. Price probably finding support at around about 197 to 200 area. So I think I expect some short-term consolidation still within this recent range consolidation, which is between about 200 to 212. Then for Tesla, I think also currently I think should be some consolidation taking place. Price went above this previous support breakdown at 215. Did a back test, but then here as support. So I think with that probably still some sideways for now. Resistance probably be at 228. This the swing high last week to about the next the previous swing high formed in end July, which was around 233. So probably some sideways price action for now also. Okay, then next up is Genting Singapore. So for Genting, I think overall it's still trending downwards. Price is probably still trending in the range for now. With support around 80 to 80.5 cents. Resistance is around 83 cents. And also this 83 cents resistance, apart from being a horizontal previous horizontal support breakdown level, is also we also have this confluence of the downwards resistance line as well. So I think for now price should be still rather sideways for the time being. And then for SATS, I think it's still carrying on its momentum after the gap up post earnings. So after the earnings, there was a gap up above this trend line over here, and then I think price is continuing to go higher today around 372. With that, I think looking back, actually filled this gap over here back in 2022. So I think price could still continue its this recent momentum upwards towards the next resistance area, probably around 380, around 383 to about 390, about there should be the next resistance area. Then followed by the next one will be a previous swing high closer to about $4. So these are next resistance levels for SATS. In short term wise, should be still continuing its this momentum for now. For Keppel, okay, for Keppel, I think some rebound recently. It's currently from this after recovering above this 585 previous low. Price did a recovery towards this previous swing low level around 620. So about 615, 620 was a previous this previous resistance area. I think price for now should do a bit of a sideways with some consolidation. Support probably be around 605, 610 area. Yeah. Okay, then for Seatrium. Okay, for Seatrium, I think after some consolidation for like I think since the start of this month, last Thursday, it broke out of this resistance at 145, 146, hit about 152. I think with that, for short term wise, we could see some slight consolidation. I think, price should be able to hold this recent breakout as a support. So I think if this holds, then we form a higher low. I think price could do a further recovery hit. But for now, maybe some sideways consolidation first. And for ST Engineering, I think is still a strong uptrend. Price is consolidating a bit at this channel resistance area, which is around 455 to about 460. Support probably be around 440s to about 445. So I think probably some sideways consolidation for the time being still. Okay, then for Semco Industries, I think price is currently still range trading. Good thing is still holding a bit of a build up at this resistance at around 480. So I think if this higher low at around 470 is still holding there, I think it could be positive for possible breakout over 480 for price to trend higher towards like $5 as the next resistance. Yeah, but for now, maybe still some sideways consolidation for the time being. Okay, then some next one is Mapletree Logistics Trust. So I think Mapletree Logistics today price broke above this downtrend resistance line over here, as well as went on to do a retest of this previous swing high around 138. So I think with that price, I think might face a bit of resistance over here, but should be able to form a higher low with this recent breakout. I think probably now 135 is turned to a support level, which was this recent resistance in start of July. I think if as long price holds as a higher low, then I think could reverse upwards higher above. Then this one is maybe Capital Land Ascenders REIT. Okay, so for Capital Land Ascenders REIT, I think price has been going up for a while. Currently retesting this around 289, 290 resistance level. With that, we could see some slight consolidation or pullback. But overall, I think the trend is still looking quite good with this bullish trend upwards when price broke above this 275 level over here. So yeah, so we might see some slight consolidation afterwards, but the trend could still continue higher afterwards. Okay, then for Wilmar, I think for now it's looking better. I think with this, if we cover above this breakdown at $3 and then subsequently price maintain this range between $3 to about $3.12. Then recently also broke above this resistance as well. So I think with that price could go a bit higher. Short-term resistance could still come in around 320, which was this previous swing low level in mid April. Yeah, and also next resistance around 325 as well. So I think short-term wise still some resistance ahead, but should slowly climb out of this this 312, 313 resistance area, previous resistance. Okay, then next one there's a question on 17 Life. Okay, on 17 Life, I think for now yeah, the volume is quite low. So as compared to during the middle of July, there was a surge in volume. But for now, I think price, I think it's doing nothing much. It's quite sideways. Resistance probably still acting from this recent highs around 94 cents to 97.5 cents. Then from the probably support now is around, I think maybe 86 cents to 88.5 cents area. So probably still quite sideways for the time being. Yeah. Okay, then here on the three local banks. So for first up for DBS, I think price should be quite sideways for the time being, holding out this $36.20 as a resistance. Support should be still coming around 35.40. So I think should be expecting some consolidation for the time being. Okay, then for UOB also, I think quite similar. After you feel this price gap around $30.90, is becoming a short-term resistance. Price should be still consolidating sideways with support around $30.50 as a first level. The next level of support is around $30.25 over there. So should be quite sideways as well. Then OCBC also quite similar. After it retested this previous support level at 14.45, which it broke down, also be acting as a short-term resistance. So with support currently around 14.20. So I think it's still consolidating in a bit of a tight range currently as well. And then there's a question on Franken. Also for Franken, I think for now it's price action also quite subdued. Volume it's coming off also. So probably just some sideways consolidation. Resistance probably currently is around 140 to 144. Support wise, we'll probably see around 132 to 135. So I think probably still some sideways consolidation for the time being. Okay, next one is on SIFMAC. So I think for SIFMAC, recently price has came off from the highs of around $1.03, but I think should be quite flattening out. With looks like a double bottom around 88 cents for now. So I think should be quite sideways. Some resistance probably possibly still around the 92 cents area, which was a previous high back in start of July. Then yeah, should be still quite sideways for the time being in the range between 88 cents to 92 cents. Okay, then for Aztec, Aztec has also been quite sideways recently. Yeah, since retesting this trend line support around 91 cents, price pretty a bounce and just sideways. Probably resistance around 96 cents, 97 cents area. Support is coming in around 93 cents to 94 cents. So yeah, should be still doing a bit of a consolidation. Next one is the Tracker Fund Hong Kong 2800. Okay, so for this yeah, I think price should be a bit of a sideways, should be doing a bit of a sideways as well for this because currently there's still a lot of prior resistance from this previous support area around $18.40, $18.50, and it's currently back into this area. So I think we may take some time to do a bit of a consolidation first. But overall, for the looking at the short term wise, it's still holding on to this trend line support over here. So I think as long as price continue to maintain higher swing lows around with support around $18 and above, then I think could see a bit of sideways consolidation, but continue to price to go up gradually in the short to mid term. Okay, for chop, I think chop I think quite sideways, but looks like it could go higher because because price previously there was some resistance around this 269 level here. Price here retest found support and continue to hold a higher low trend in this stretch over here since start of July. So I think with that, price would likely to retest this swing high over here around 278. Then afterwards, it could continue its slow and steady upwards movement. And then for Occidental Petroleum, I think it's still a downtrend for now, and price still should be quite sideways. Finding support around 55 to 56 cents. Sorry, 55 to $56. So we could see some rebound back towards this range resistance around 58 to $59, where this was a higher support breakdown level. So I think it should be quite sideways for Oxy for the time being. Yeah, then for the BOTS ETF, which is this global robotics AI ETF, trend wise, it still continue to climb up over here. So I think with that, should still expect price to go to retest some previous resistance. The first key one being around 32.40, about there. The next one will be a previous high around 33.50. So I think a trend is still intact for this this bullish short term trend. Okay, then there's a question on BITO, which is the ProShares Bitcoin Strategy ETFs. I think with this, the main trend is still being bound by this downtrend channel, which is in blue. So I think you could see some recent price action wise, it was a range consolidation between around 18.80 to about $20. If a Friday where price broke above this $20 mark, we could see some recovery upwards towards about 21.50, 21.60. Then you might need some resistance again from this channel. Yeah. And then the H22, it's Hong Leong Asia. So I think Hong Leong Asia, the trend is still bullish. Price did a range consolidation over here, breaking above the 74.5 cents level to continue to move upwards today, hitting 80 cents. With that, I think it could likely still continue its this bullish trend. Next resistance level to look out is around 81 cents to about 82 cents area. Okay, then next one is Digicore REITs. Okay, so for Digicore REIT, I think it's rather sideways since February until now. Support is around 54 cents, resistance around 63 cents. So this is still kept in this range. So I think price will be still it could go a bit higher to test this resistance and continue its consolidation. And then there's a question on Standard Chartered. Before Standard Chart, I think it's rather sideways for the time being, but this previous resistance around 71, 72 dollars held as a support twice over here recently. Then it's coming up to probably retest this resistance around 79 again. So short term wise might be still range bound, but bigger picture, looking at bigger picture, it could still go higher towards the next key resistance around like 82 dollars. Because overall the overall trend is still an uptrend. Yeah, then short term wise is range consolidation. Okay, then there's a question on city developments. City developments chart still downtrending. So I think for now we could expect some range bound action. Recently it looks like the double bottom form at around $5. Price is rebounding towards a resistance area for now, which is around 530 to 535 area. I expect some resistance to come in at this area for price to do some consolidation. And U14, it's UOL. So for UOL, I think it's also quite similar. So price coming close to near the resistance area again, which is around 545 to 550s. So probably a retest, then price could just do a bit of a consolidation again after. Okay, 9618 is JD. For JD, I think after it trend downward since end of May, currently it's a bit of a range for the time being with support still around $99 support here. Yeah, so I think the key resistance around 113. Recently there was some large price movement where price went up, then after this gap down over here. So I think for now, There might be some sideways price movement with a first level of resistance around $107, $108. Then support wise, we're likely to see around 102, 103. So maybe some sideways consolidation first. Is dynamic still a good buy? Okay, looking at looking at this question from a TA perspective, I think if you're looking at buy, I think maybe you can see whether price retest this uptrend support line again, as well as this swing low support around 55 cents area. Yeah, then overall, I think it's still in this uptrend, was short-term wise a bit of a sideways consolidation, so it might still be a good buy around 55 cents support area. Okay, question is on micro mechanics. Okay, micro mechanics, I think since a breakdown of this support at 155 in start of this month, price has been quite sideways. So I expect still some consolidation around this 143 to 154, 155 area. For prop next. Yeah, prop next should be did a retest of the swing low around 75.5 cents, then did a bit of recovery. Currently doing some sideways at a previous support area, currently some resistance around 80 cents. So I expect still some sideways price action with resistance from around 80 cents over 82 cents, then support probably around 78 cents, 79 cents for the time being. Okay, then for Thai Bev, Thai Bev, generally I think still the range still quite range bound. Since holding the 47 cents support price is still doing some rebound. Yeah, hopefully we see another retest of this range resistance again around 52 cents. Then there's a question on China Aviation Oil. For China Aviation Oil, I think price it's still a bit of a consolidation over here. Yeah, still bounded by support is still around 84, 85 cents area. Then key resistance is still holding out around 90 cents. So still in a bit of a consolidation since start of this year, February. Then there's a question on Jardine CNC. So for Jardine CNC, price is still continuing some rebound trend over here since breaking out this range consolidation around $26. Yeah, so I think for now we should still see this short-term rebound trend continue with key resistance is around 28.50 onwards to about 29.20. Then short-term support wise, if it does a bit of sideways, support should come in around $27 to about 27.30. Then there's a question on Grand Venture. On Grand Venture, generally this counter doesn't have much volume, but short-term wise, I think might be doing a bit of a sideways consolidation. Previously, I think end of July, there was a break below this uptrend support line, and then this 56 cents range support level there's a bit of resistance. So I think current support wise is around 52 to 53 cents this prior range resistance area. So I think it should be consolidating in this 53 to 56 cents area for the time being. Yeah, so that's my take on Grand Venture. I think that's all the TA questions. I'll hand back time to my colleagues to answer the other questions. Thanks.
Yeah, let me take this one on Ascendas versus Mapletree Industrial, which you prefer in terms of business. I think Ascendas has more business parks and these are not doing well. Yeah, you're right that they have a bigger percentage of their business in for Ascendas, they have bigger proportion of their area in business parks, which accounts for about 37%. But these business parks are mostly in Singapore as compared to Mapletree Industrial. They have about 5.9% of their assets in business parks. But despite saying that the business parks supposed to be weaker and not doing well, CapitaLand and Ascendas, they managed to have some good rental reversions in the business parks. So they had a 5.8% positive rental reversion in the business parks in the first quarter, and the second quarter is 8.3%. So it's still relatively resilient. But but CapitaLand, Ascendas REIT, they have indicated that they would definitely want to expand their data center exposure. Right now, it's about 10% only as compared to the DC exposure for Mapletree Industrial. If I'm not right, it's 50 over percent. Yeah. So yeah, that's the comments I have for those. And Probably is entering the REITs now, and if DPU drops further from here, it will pull the unit price lower. We need to buy the lowest DPU payout level. Yeah, you're right as well to a sense, but we forecast the DPU to return to growth next year, especially since at least 75 basis points of cuts are expected this year. So they will translate into some savings next year already from REITs that have a lower hedging ratio and those who have not previously fixed their loans, or rather have their loans on fixed rates. Because a lot of REITs they also do not take on loans directly fixed from the banks. So a lot of the REITs, they just borrow on the floating and they hedge separately through interest rate swaps. So a lot of these swaps are also expiring by year end. So this will also benefit a lot of the REITs. So we do expect a DPU to grow next year. Year-on-year basis, yeah. Yeah, I think that's all for me. Yeah.
Okay. Yeah. Thanks. Yeah. So actually, on that question is do you wait for the actual results to turn, or you want to buy ahead of expectations? So our view is to buy ahead. It's almost the same thing. The REITs didn't correct, even though interest rates was rising until the later. I think after the first few rate hikes, I think the REITs actually dropped that much, and also analysts also didn't really cut their numbers. So for us, it's more we want to buy ahead of the actuals rather than wait until the actual DPU start to recover, then start to buy. I mean, that's our general view. Let me just answer this last one, and then I think then we'll just pan it back to Darren to end it. With rates coming down, is short-term or long-term bonds a better buy? My own thoughts, of course, in theory, long-term bonds should be better because when they are the most sensitive, because when rates down there, of course, the convexity, the volatility there is higher. But my own view is to the short-term bonds, because right now we are the inverted curve. That means the short-term rates are higher than long-term. I think they look at the US now, 2-year notes is about 4 point something versus the US 10-year about 3 point something, 3.75, I think. So for me, it's to buy the shorter term, because you might get the inversion benefit. That means the short end actually drop more than the long end. So you get the capital gain higher. That's my own view because of the inversion. I think I hand it over to Darren. I think you can end it with taking those two questions. Yeah. Thanks for the questions, everyone.
Yeah. Yeah, so there are a couple of questions on Keppel REIT. What's my view? And Keppel REIT P at 27 times too high vis-a-vis market. Yeah, so for REITs, we do not generally value REITs by PE. So yeah, we do not compare the 27 times PE to the market. Yeah, we usually use either DDM or DCF for REITs because it's more of a dividend play. So we just discount the dividends or free cash flow to get valuations. So we don't really compare that on a PE basis. But for Keppel REIT, basically in the first half, they had some very good reversions as well, or portfolio rental reversions of 9%, 9.3%. Yeah, but we expect this 9.3% to come down in the second half, as we mentioned that IOI Central Boulevard Towers, the phase 1 has already completed, and phase 2 is basically is slated to complete the third quarter. So in total, that will bring about 1.2 million square foot of space into of new supply basically. And right now is only about 45% pre-committed, and 20% is still under negotiation. So after the new supply comes in, we expect a vacancy in the whole office sector in the CBD grade A space to creep up, and that will likely also impact rents. So right now rents are about 11.95 for the average core CBD grade A. We think that will likely come down in the second half with this new incoming supply. And this IOI Central Boulevard Tower is not the only supply coming. Next year there's still the Shaw Tower redevelopment and Keppel South Central, and both of those combined will add another 1 million of new supply. So in total, if you combine, IOI is upwards of 2 million square foot of space. So yeah, it's a lot of supply, and yeah, we expect rental reversals to come down for Keppel REIT as well going forward. And but the thing is that's because their rents are still lower than the market. So there's still a bit of potential for them to get a little bit more positive rent reversions. But yeah, but generally the whole market rents, you think it will start coming down.
Yeah, there's a webinar tomorrow, so everyone can join in for know more about Keppel.
Yeah, there's a Keppel webinar at 12. Yep, and you can ask them any questions, and yeah, especially the worry on the supply that's on everyone's head right now. Yep. So I guess there's no more questions. I guess we can end here. If not, Paul, you have anything? If not, I will end it.
Yeah, I think you can just end it. Yeah, thanks.
Yeah. Then thanks everyone for joining us again. We have some upcoming webinars like Keppel REIT and VinFast on Wednesday as well. So please join us, as well as Micro Mechanics webinar also on this Friday. So please join us if you are free. And yeah, if not, then let's end this webinar and hope to see you again next week for our usual Monday webinar. Thanks. Bye-bye.